Hi guys, welcome to my channel. So before we get started, make sure to hit that like button and also subscribe my channel. In this video, we will talk about Forex trading for beginners. Can you really make money? So make sure to watch the full video. Forex trading may make you rich if you are a hedge fund with deep pockets or an unusually skilled currency trader. But for the average retail trader, rather than being an easy road to riches, Forex trading can be a rocky highway to enormous losses and potential penury. Unexpected events. To better understand the danger of Forex trading, consider a relatively recent example. On January 15, 2015, the Swiss National Bank abandoned the Swiss franc's cap of 1.20 against the euro that it had in place for 3 years. As a result, the Swiss franc soared as much as 41% against the euro on that day. The surprise move from Switzerland's central bank inflicted losses running into the hundreds of millions of dollars on innumerable participants in Forex trading, from small retail investors to large banks. Losses in retail trading accounts wiped out the capital of at least 3 brokerages, rendering them insolvent, and took FXCM, then the largest retail Forex brokerage in the United States, to the verge of bankruptcy. Excessive leverage. Although currencies can be volatile, violent gyrations like that of the aforementioned Swiss franc are not that common. For example, a substantial move that takes the euro from 1.20 to 1.10 versus the US dollar over a week is still a change of less than 10%. Stocks, on the other hand, can easily trade up or down 20% or more in a single day. But the allure of Forex trading lies in the huge leverage provided by Forex brokerages, which can magnify gains and losses. A trader who shorts $5,000 worth of euros against the US dollar at 1.20 and then covers the short position at 1.10 would make a tidy profit of $500 or 8.33%. If the trader used the maximum leverage of 50 to 1 permitted in the US, ignoring trading costs and commissions, the profit is $25,000 or 416.67%. Of course, had the trader been long euro at 1.20, used 50 to 1 leverage, and exited the trade at 1.10, the potential loss would have been $25,000. In some overseas jurisdictions, leverage can be as much as 200 to 1 or even higher. Because excessive leverage is the single biggest risk factor in retail Forex trading, regulators in a number of nations are clamping down on it. Asymmetric risk to reward. Seasoned Forex traders keep their losses small and offset these with sizable gains when their currency call proves to be correct. Most retail traders, however, do it the other way around, making small profits on a number of positions, but then holding on to a losing trade for too long and incurring a substantial loss. This can also result in losing more than your initial investment. Platform or system malfunction. Imagine your plight if you have a large position and are unable to close a trade because of a platform malfunction or system failure, which could be anything from a power outage to an internet overload or computer crash. This category would also include exceptionally volatile times when orders such as stop losses do not work. For instance, many traders had tight stop losses in place on their short Swiss franc positions before the currency surged on January 15, 2015. However, these proved ineffective because liquidity dried up even as everyone stampeded to close their short franc positions. No information edge. The biggest Forex trading banks have massive trading operations that are plugged into the currency world and have an information edge, for example, commercial Forex flows and covered government intervention, that is not available to the retail trader. Currency volatility. Recall the Swiss franc example. High degrees of leverage mean that trading capital can be depleted very quickly during periods of unusual currency volatility. These events can come suddenly and move the markets before most individual traders have an opportunity to react. OTC market. The Forex market is an over-the-counter market that is not centralized and regulated like the stock or futures markets. This also means that Forex trades are not guaranteed by any type of clearing organization, which can give rise to counterparty risk. Fraud and market manipulation. There have been occasional cases of fraud in the Forex market, such as that of Secure Investment, which disappeared with more than $1 billion of investor funds in 2014. Market manipulation of Forex rates has also been rampant and has involved some of the biggest players. In May 2015, for example, 5 major banks were fined nearly $6 billion for attempting to manipulate exchange rates between 2007 and 2013, bringing total fines levied on these 5 banks to nearly $9 billion. A common way for market movers to manipulate the markets is through a strategy called stop-loss hunting. These large organizations will coordinate price drops or rises to where they anticipate retail traders will have set their stop-loss orders. When those are triggered automatically by price movement, the Forex position is sold, and it can create a waterfall effect of selling as each stop-loss point is triggered, and can net large profits for the market mover. Is trading Forex profitable? Forex trading can be profitable, but it is important to consider time frames. It is easy to be profitable in the short term, such as when measured in days or weeks. However, to be profitable over multiple years, it's usually much easier when you have a large amount of cash to leverage, and you have a system in place to manage risk. Many retail traders do not survive Forex trading for more than a few months or years. Is Forex high risk? Although Forex trades are limited to percentages of a single point, they are very high risk. The amount needed to turn a significant profit in Forex is substantial, and so many traders are highly leveraged. The hope is that their leverage will result in profit, but more often than not, leveraged positions increase losses exponentially. Is Forex riskier than stocks? Forex trading is a different trading style than how most people trade stocks. The majority of stock traders will purchase stocks and hold them for sometimes years, whereas Forex trading is done by the minute, hour, and day. The time frames are much shorter, and the price movements have a more pronounced effect due to leverage. A 1% move in a stock is not much, but a 1% move in a currency pair is fairly large. Investors can trade almost any currency in the world through foreign exchange, Forex. In order to make money in Forex, you should be aware that you are taking on a speculative risk. In essence, you are betting that the value of one currency will increase relative to another. The expected return of currency trading is similar to the money market and lower than stocks or bonds. However, it is possible to increase both returns and risk by using leverage. Currency trading is generally more profitable for active traders than passive investors. Buying and selling currency explained. It is important to note that currencies are traded and priced in pairs. For example, you may have seen a currency quote for an EUR/USD pair of on 1256. In this example, the base currency is the euro. The US dollar is the quote currency. In all currency quote cases, the base currency is worth 1 unit. The quoted currency is the amount of currency that 1 unit of the base currency can buy. Based on our previous example, all that means is that 1 euro can buy 1256 US dollars. An investor can make money in Forex by appreciation in the value of the quoted currency or by a decrease in value of the base currency. Another perspective on currency trading comes from considering the position an investor is taking on each currency pair. The base currency can be thought of as a short position because you are selling the base currency to purchase the quoted currency. In turn, the quoted currency can be seen as a long position on the currency pair. In our example above, we see that 1 euro can purchase $1 and 1,256 cents and vice versa. To buy the euros, the investor must first go short on the US dollar to go long on the euro. To make money on this investment, the investor will have to sell back the euros when their value appreciates relative to the US dollar. For instance, let's assume the value of the euro appreciates to $1 and 1,266 cents. On a lot of 100,000 euros, the investor would gain $100, $112,660, $112,560 if they sold the euros at this exchange rate. Conversely, if the EUR/USD exchange rate fell from $1 and 1,256 cents to $1 and 1,246 cents, Then the investor would lose $100, $112,460, $112,560. Advantages for active traders. The currency market is a paradise for active traders. The Forex market is the most liquid market in the world. Commissions are often zero, and bid-ask spreads are near zero. Spreads near 1 pip are common for some currency pairs. It is possible to frequently trade Forex without high transaction costs. With Forex, there is always a bull market somewhere. The long-short nature of Forex, the diversity of global currencies, and the low or even negative correlation of many currencies with stock markets ensures constant opportunities to trade. There is no need to sit on the sidelines for years during bear markets. Although Forex has a reputation as risky, it is actually an ideal place to get started with active trading. Currencies are generally less volatile than stocks as long as you don't use leverage. The low returns for passive investment in the Forex market also make it much harder to confuse a bull market with being a financial genius. If you can make money in the Forex market, you can make it anywhere. Finally, the Forex market offers access to much higher levels of leverage for experienced traders. Regulation T sharply limits the maximum leverage available to stock investors in the United States. It is usually possible to get 50-to-1 leverage in the Forex market, and it is sometimes possible to get 400-to-1 leverage. This high leverage is one of the reasons for the risky reputation of currency trading. Disadvantages for passive investors. Passive investors seldom make money in the Forex market. The first reason is that returns to passively holding foreign currencies are low, similar to the money market. If you think about it, that makes sense. When U.S. investors buy euros in the Forex market, they are really investing in the EU's money market. Money markets around the world generally have low expected returns, and so does Forex. The benefits of the Forex market for active traders are usually useless or even harmful for passive investors. Low trading costs mean very little if you do not trade very much. Using high leverage without a stop-loss order can lead to large losses. On the other hand, using stop-loss orders essentially turns an investor into an active trader. Getting started with Forex. The Forex market was once much less accessible to average investors, but getting started is easy now. Many large brokerages, such as Fidelity, offer Forex trading to their customers. Specialized Forex brokers, such as OANDA, make sophisticated tools available to traders with balances as low as $1. What do you think about our video? Let me know in the comment section below. If you enjoyed this video, make sure hit that like button. Also subscribe our channel before you go. Thank you for watching video.